afternoon, everybody. I'd like to welcome you here to our session today entitled Maximising Wealth for People Working in Financial Services. My name is Maura O'Neill. I'm here today in capacity as Chair of ACCA Ireland Financial Services Panel. My day job is a Portfolio Manager in Goodbody Stockbrokers, and we're coming to you today from a lovely setting in the iconic offices in the Masonry in Thomas Street. We're a very interesting panel of speakers, and I'm really looking forward to their insights. So without further ado, I'd like to introduce my panel of participants today. Paul Kenny, who's well known to everybody, currently I suppose with the Retirement Planning Council of Ireland. Stephen Gillick, Partner Head of Pensions in Mason Hayes & Curran, and Rafe Benson, Founder and Director with MoneyCube. So you're all very welcome, gentlemen, to our session here today. And I suppose it's that time of year. We hear the pension ads on the radio again, and you know, our session today focuses, I suppose, primarily on people in professional services, but I think a lot of us kind of, you know, unless we're working in the industry, we sort of switch off a little bit when we hear, or we sort of say, oh, here we go again, pensions awareness. We hear all the ads from the various life offices telling us how good their pension performance is or whatever. But I suppose one thing I've learned over the years is that pensions, it's a very important asset. It's a very important thing to provide for. It's an important part of, I suppose, our inheritance and all of that. But we tend to, particularly as professionals, maybe sometimes, you know, push it to one side, and it's always tomorrow and we're always busy. And I suppose one thing that I'd like to I suppose, get from the session today is that if we could all, you know, maybe just highlight the importance of it and the why. You know, pensions can get very, very technical, and there's all sorts of different rules depending on different schemes, and people work in different jurisdictions, they move companies, all of that. But that's what advisors are for. But I think if we could just get across the concept of, you know, we should do it. That there's benefits for doing it, both in terms of building an asset, but also some tax breaks. So just Paul, if I might start with you, focusing on, you know, the area of professionals. You've many years' experience both as ombudsman and in the industry and the Retirement Planning Council of Ireland. And maybe if we look at Retirement Planning Council of Ireland and just say, well, you know, how many professionals do you encounter, say in the particular space we're looking at here today, who maybe haven't really provided for their pension or need guidance, or sort of maybe realise after all the years of you know, being in a professional industry practice that, gosh, I don't really have much of a pot, or I never knew that, or I don't even know that I'm entitled to a state pension.
Yeah, well, in fact, that's the funny thing. I suppose one of the things about working with the Retirement Planning Council is that we generally meet people who are reasonably well provided for pension-wise. Sure. They're coming along and they're prepared for retirement financially. One of the things we always say to people when we're doing our courses is that the finance piece is the piece that people see, the tip of the iceberg, so to speak. And underneath the iceberg are the other things, the personal things, the emotional things, the psychological piece that people don't see. And they're the things that we tend to concentrate on because of that. But at the same time, I remember meeting one gentleman who was a very high-powered person in high finance, no problem, could, you know, invest with the best of them and so on, and had not one single clue about his social welfare entitlements.
Yes.
Total mystery to him.
Yes.
You know, he'd been paying through the nose, I might add, PRSI for all his working life, and he hadn't a notion about what he was entitled to.
Yeah, and a guaranteed income for life, regardless of amount, is not to be sneezed at. Yeah. You know, what the state pension is.
It's very important now, because the maximum amount of the social welfare state pension contributory is enough to get you off the hook if you're going into the ARF route, and that you don't have to set up an AMRF because you qualify with the minimum guaranteed pension if you're getting the full rate of state pension contributory. You know, it's over 13,000 now a year, so it's not to be sneezed at.
Absolutely.
And the thing is that people very often leave that sort of thing to the very last minute, and then they fail to apply on time. And at the other end of the spectrum, I find people who probably will get a non-contributory pension or something. And there was one gentleman I met who didn't apply on time because he'd forgotten how old he was.
Yes, yeah, I know. Yeah.
I think what we find as well, Maura, is like there's a huge range out there. And some of what you're saying, Paul, there, I think highlights that from people who are, you know, extremely well provided for to people who haven't given it a thought. But on the whole, like, it's rare that you see a situation where there isn't something that some actions you could take that will improve your position, And I think, as professionals, like, if somebody, failed to pay, I don't know, a 20k invoice, we'd definitely be chasing it down and making sure it came in the door and all the rest of it. But when it comes to pensions, somehow we leave a lot of money on the table through kind of not taking charge of it.
Sure.
That's
we might come back around to that later on, because often, if people have moved around a lot, there's the issue, and we'll come back to maybe near the end, just of tracing previous pensions. That's important as well. And I suppose, we get our health checked and we get our cars checked and all of that, but there's nothing mandatory to make people check their pension situation. And I often think it's something, if you can even maybe just diary it, to do it every couple of years. It's like people say, well, review your will every 5 years, maybe review your pension every so often as well. And Stephen, if I may come to you, you're obviously working in the legal field, and you would spend a lot of your time, as I understand it, advising very large corporates about, their pension schemes for their employees, about, merging schemes, pension reconstructions, all of that. But maybe, again, this is another gap in people working in professional services. They're very conscious of their clients' pension provisions, very conscious maybe of pension provision for their staff, but maybe not themselves. So could you comment on that?
100%. I agree more. I mean, I advise big clients, and I mean, you'd have some very complicated pension schemes for their staff, and there'd be some individuals who'd know their way around investments, know their way around the obligations in relation to making decisions on the pension scheme. But then there'd be a large cohort of people that don't have a clue about pensions, and they're very educated people in other respects, but for various reasons they acquiesce in relation to pensions, probably due to confusion, maybe too many choices, and they fail to make decisions or fail to adequately understand the benefit of a pension. The company may look after certain financial services individuals, that'd be great, but not all employers have a paternalistic attitude for pensions. Some employers take the attitude that you're an educated individual, we pay you well, now go off, take that lump of money and set up your own pension. Maybe that's as far as that conversation gets, because the individual might go, you know what, I've got fresh fees, I've got the car loan, the mortgage, etc., etc. I'm not going to put the
and
money
I'm only
into
XYZ age, so I've got years to go yet.
Exactly. You can see individuals, I mean, the mantra for pensions is start early. I mean, but I think professionals can be guilty as anyone else, and people in financial services, of not heeding that message and not starting a pension or not putting sufficient money aside into that pension for various reasons, which, I mean, we can go into societal reasons why people can't afford to put into a pension. But I think if they better understood the tax benefits and the other benefits of a pension,
yes, indeed,
they would be more inclined to do it.
So I'm sort of getting the sense from you that maybe we should just have some more education in general, as to the why.
100%
and leave the technical aspect maybe to the professional advisors, but the why doesn't seem to resonate with a lot of people until, as we said earlier, it's too late. And you mentioned tax there, so Rafe, maybe you might just cover off some of the, we've seen various, I suppose, tax reliefs disappear over the years, and it's one of the few decent tax reliefs that's there. And obviously, when the assets are within the pension fund, and then even, God forbid, if something happens to somebody, sometimes, depending on the pension, they may be able to access the pension pot tax free, or a certain multiple of someone's salary. So would you comment a little bit about all the tax benefits? And that usually, I think, makes Irish people's ears, I can save a bit of tax, or this is tax effective. And would you just take us on a brief journey through that?
I guess, tax in general is difficult to escape around here, but there's no doubt that the government really want you to use a pension to plan to pay for your years when you finish working, and they incentivise that very heavily through the tax system. It's really the last show in town when it comes to a decent way to save on tax. And I guess there are three big tax tailwinds with a pension. The first is that the money that goes in receives tax relief at your top rate of income tax. So effectively, for somebody paying 40% tax, you can drop every 60 euro that you drop into your pension turns into 100 euro in your pension account. So that's 67% growth right off the bat. Secondly, once it's in that kind of tax envelope, it grows free of tax. You know, and then the third big kicker is that when you do hang up your boots, you can take out a sum of up to 200k free of tax. You know, so definitely, you know, that really powers your returns, and you know, there aren't many competitive alternatives that are going to do that with you. But I think more than, you know, just to build on what Stephen is saying there about you know, I'm an accountant by trade, and like we've got a saying that you know, customers kind of look at what accountants do and they kind of think, well, actually I could probably do that myself, because that's dealing with numbers, whereas when it comes to legal stuff, that's it's almost like a foreign language, and so you know,
We like
clients
to keep it that way.
yeah,
really.
so clients are happier maybe to take the lead of their lawyers on those things, and I think that's probably some of that that kind of feeling filters through when it comes to our personal wealth and our pensions, which is a feeling that, well, gosh, I ought to be able to know my way around this because it's just numbers, and it is, but at the same time, you know, it's technical in the sense that we've got you know, rules that have been built up over many years. So kind of navigating your way around that, there's definitely money to be won and lost by doing that. But you know, at heart, you know, the act of kind of investing money for growth is a simple one that any competent advisor ought to be able to help you with.
Okay,
Speaking of a foreign language, the problem is jargon.
Yes.
You know, and people just freeze. They switch off completely. They're like rabbits in the headlights, you know, when they're faced with the kind of technical jargon that they're often faced with. And you know, it doesn't take much more talent to write in plain English
Totally.
than it does to, and one of the issues we have all the time is regulation, because the regulation is all very well intentioned, you know, disclosure of information, blah de blah, and so forth, and at the same time, that drives the providers and the consultants into the lawyer. They want the legal department to say, this is okay, this is complete, the pensions authority is not going to be on my back because I've left something out. And
you must mention it because it's part of regulation, which is fine, but it's how you mention it and how you get it across to...
You've got to step back and say, will the person who's going to receive this understand it? And very often, if you think about it, they won't.
Yeah. And the example I'd use, Paul, to highlight that confusion is one that always leaves me scratching my head. I remember the water charges, and we all remember the protests in town. And I think the water charges were on average going to be 300, 400 euros per person per year, and there were cars overturned and riots in the street and all sort of hullabaloo. At the same time, the government were bringing in the moves to extend the state pension from age 65 to 68. So with a tick of a pen, people were losing 13,000 euros per year. So I know there's been a bit of a rollback on that, but the potential loss there was 39,000 euros. And people just didn't have a clue, didn't want to engage, couldn't engage because of the jargon, because of the confusion. Whereas over the 300 euros a year bill for water from the sky
They
that we
understood
own,
it.
there was total right. So it is definitely, I'd hate to call it a lack of knowledge, but it's a lack of understanding. And perhaps we on the panel here, certainly me as a lawyer, I know I feed into sometimes marking up documents.
We're all guilty of being too technical.
You've actually identified the real problem there, because 39,000 is finance, 300 is money. And, you know, people understand money.
Money in the
The
pocket.
small change they understand.
Indeed.
The big stuff they don't.
Exactly. And I suppose, you know, if you use the car analogy again, when you go to get your car service, you know it needs doing, but the mechanic isn't going to tell you every single thing that's going on under the engine, you know, and it's almost just to say, I've done it and it's in a good position now. And, you know, pension or financial advice should be no different. People don't necessarily need to know the basis of the legislation or the basis of the rules, but they have to kind of understand where they're headed, you know, and that's where a good advisor, I suppose, comes in again. Stephen, there, you mentioned about, you know, pension age, and, you know, that kind of brings me into my next question. People often confuse with taking pension benefits and, you know, when they actually can leave money, you know, taking pension benefits and how long they work for. And often people think that they coincide. So, you know, if I can draw a pension at 60, does that mean I have to retire at 60 as well? And what we're seeing a lot more people working for longer. And I suppose people can still contribute to pensions over age 60, and as far as I know, get a 40% tax break. They can contribute 40% of a certain level of income. So I think people sometimes think, God, have I left too late? But it is possible to still provide for pension, and correct me if I'm wrong here, Paul, between 60 and 75. So there's still that window there. So maybe you haven't left it too late. And, you know, I think that's sort of important, because I think we're kind of headed in that direction where people are going to work for longer. But that can be a good thing with regard to providing for some private pension provision for yourself as well.
I think it's inevitable that people will work for longer. I mean, the fact is that people are living better for longer. And, you know, when I started in pension in old God's time, the man who got to 65 was calculated on average by the actuaries to live for 13 years and a woman for about 17 years. That has increased by 50% over the 50 years since then. You know, we're now talking about the possibility of somebody, a man living to or beyond 90 is now 47%, and I think it's 55% for a woman.
Okay.
You know, and there will be people, there'll be a lot of people out there who will live to over 100. And that really means that the period of their retirement could be as long as the time they spend working.
Yeah.
And that's why it's so important to make provision, because you don't know how long you're going to live, but it could be a very, very long time, and you need to make sure that you can have the kind of quality of life that you would like in retirement, because it's going to be a very long time for a lot of people, not everybody, admittedly. And, you know, the reason that people retire at 65 was because Bismarck asked his associates what was the average age of death in Germany, and they said 65. So on that basis, Bismarck reckoned that he wouldn't have to pay pensions to more than half the population on average.
Of course, yeah. He was looking ahead at the life expectancies or whatever.
Exactly.
Indeed.
But now the life expectancy has increased enormously.
Indeed, yeah.
And you know, it may go back, and in some places it has actually gone into reverse. I think in parts of the north of England, it is actually, the trend has been reversed rather than continuing. But for most of us, you know, that trend will continue.
Sure.
And that's certainly something more I'm seeing from a legal perspective, a disconnect between a contractual retirement age and what is allowed in the pension scheme documentation. Most pension scheme documents allow various retirement ages and allow flexibility, but employment contracts are more difficult to place flexibility, so it usually sets an age in stone in the employment contract, and a change to employment contract has to be negotiated between the employer and employee, whereas the pension scheme, generally speaking, allows a bit of flexibility. So we're seeing often just trying to match up what is a contractual retirement age with the retirement age under the scheme. And you have to factor that in from an investment perspective in a pension, because you want the pension to have an end date, an aim for the retirement, at which the assets, obviously, they have to be placed in, for instance, cash as a retirement as approach to the lifestyling. So there's various disconnects that I'm seeing between that, and in the future it's going to be different. I mean, we're all familiar with Macy's and seeing people work in 80s and 90s in New York and America when we go over. Is that something that as a country we want? Do we want our employees or our citizens to be able to work? I think we certainly want them to be able to work. But is it something they want to do, or is it something they have to do?
Yeah, indeed.
In some cases they will have to do it, and you know, in the Retirement Planning Council we come across people in all walks of life, and they have different reasons for retiring. Like when you get people whose jobs are physically demanding, nurses, physiotherapists, those sort of professions, you know, there comes a time when they're physically not up to the demands of the job. And I remember meeting a nurse a couple of years ago at one of our courses who said, I'm 58 and I'm going to spend the next 7 years working in Marks and Spencer's.
Okay.
And if you go into Marks and Spencer's, you will notice that there's a lot of people in that age bracket.
There is indeed. You know, want to keep working, but in a different type of work, maybe.
Because I think, like, careers have actually changed, and probably none more so than people working in professional services. But our approach to pensions hasn't necessarily caught up with that. So for me, like, I think it also then, if you're going to take charge of your career in that way and, you know, initiate changes and maybe have a couple of different professions through your career, and certainly, you know, if you're a professional accountant, lawyer, whatnot, you may end up being an employee or self-employed at a certain period or whatever. You've got an equivalent need to take charge of your pension and your wider wealth as part of that, and really think about that and how that fits into what employment structure you're in, what the trajectory of your earnings is going to be. So, it might be, you might, say a medical person might spend a very long period in training, living on beans and rice, during which they'd probably quite rightly be doing next to nothing to fund their pension. But then how do you catch up in those key earning years? Or if you are planning to have maybe a step down in earnings, have you thought about the long-term implications, not just my paycheck's going to fall next month because I'm doing something I want to do, but also actually that's going to have a longer term funding implication for what I'm ploughing into my retirement fund.
And you would see that, Rafe, in the legal profession. Certainly you're seeing a move towards people going in-house and then spending a certain percentage of time possibly self-employed, be it a barrister possibly beforehand. So it's a disconnect as to how all of these benefits work in terms of providing a retirement income.
Yes.
Because as Paul can allude to and nobody was seeing, people often lose track of various entitlements
Indeed.
as they move through their working
Sure.
life and different
Yeah,
forms.
and the pension rules apply to the size of your pot at the end. So, in terms of pension caps, it looks at your pensions from all sources, be it self-employed or employment. So it is very important to think of them all as one block. And, coming back to what you're saying, Rafe, there about starting early, like at its simplest form, pensions is savings, tax-effective savings. And, really most people would like to save, so why not do it in a tax efficient way? And I suppose the other thing I would see in my day job, when people are looking at financial plans, and I'm sure you see it as well, Rafe, and they actually list their assets. Sometimes they don't think of their pension as an asset, so they have their house, they have their business, they have maybe their holiday home, whatever it might be, and their investment portfolios, and then over there somewhere is the pension. But actually, if they put the pension into the mix, the pension sometimes, in terms of percentage of value, can actually be 20, 30, 50%. It can be more valuable than your house. So it sounds corny, but what's not to like about that? So it's just how do you get to really build up such a valuable asset to you? And you have to think of it, I suppose, in terms of totality. And our job maybe is to educate people, sort of saying it is a form of savings. It's good for tax breaks, and it forms part of your overall assets. It forms part of what you want to pass on to your children, maybe, or whatever. So, would you have a comment on any of that?
Yeah, I think I would certainly say, the financial services industry has done a reasonable job of helping people feel like this is not their money. The letter in the post every 6 months or whatever, it doesn't really cut it in a world where I'm clicking onto Revolution and buying my crypto, or getting a snapshot right there of what I'm worth today. So I think the industry has a journey to go on to kind of bring people closer to their money, because it is their money. And we need to start talking about pensions in terms of, as you say, our overall wealth. The two pockets of, certainly for people in Ireland, the two pockets of wealth tend to be long on property, and if we're doing all right, we may have some reasonable pension provision. So it needs the same degree of care that one would have, and yet we get customers and maybe have a relatively smaller investment portfolio which they're checking on a daily basis, and the pension over here is could be languishing in a fund which was absolutely right for them 15 years ago, but has been on autopilot since. So a lot of it is about kind of engaging with this, because it's your money, it's part of your wealth, and there are euros to be won and lost by actually by optimizing it for your circumstances. Could be around costs, could be around investment choice, could be around use it or lose it, tax breaks to put money in.
Yeah, and I suppose often, as you refer to the Irish psyche and property there, and people think, oh, sure, look, I have 3 or 4 investment properties and they're going to provide me with an income. But what people are missing there, which is great, and they can have that as well, what people are missing there is the tax break they get and the gross roll up while they're investing within a pension. So sure, but rental income is taxable income the whole way through, provided you haven't got enough expenses set off against it. So you can sort of do the same thing with a broad range of assets. So you're still saving, you're still investing, but you're kind of getting a tax break to do it. And it's just to try and remember that all of the time, really.
Yeah, and I think if you look more, I think one of the Sunday newspapers has a kind of finance section in it where they ask totally intrusive questions such as, how much did you earn last year? And it's gas rating.
Are you better off than your parents?
Yes, yeah, and nobody ever answers how much did you earn last year, which is a real juicy one. But one of the questions is, pensions are property.
Oh yeah.
And each week, without fail, it comes back to pension. I do not have a clue. Property, I either own my house or I'm paying a mortgage. But without fail, if you go and look at it at the weekend, pensions, nobody ever speaks with great authority on pensions. And I think, going back to your point, Rafe, excuse me, it comes down to technology. Because everyone has Revolut. Now, I have Revolut, barely know how to drive the thing, but everyone has it. Whereas pensions are still stuck in the mud. Because if you even look at IORP2 brought in the new pensions benefit statement that has to be sent out to people, the thing that is used to kind of prop up a wonky table in the house when they get it in.
And just for some of our audience, you might just very briefly explain what IORP2 is.
Oh, IORP2 is...
I'm pulling you up in the technicals now.
No,
Steve.
it's a new... it sounds like some sort of character out of Star Wars, but no, it's not. It's a new piece of pensions legislation, which we should have brought in maybe 2 years ago, but we brought it in late. And it's led to big changes across the board in relation to pensions, which I won't bore the audience with, but it has been possibly the biggest change in 10, 15 years in the pensions landscape in Ireland. But it did bring in a new pensions benefit statement, which will replace the annual benefit statement which people get, which states contributions in age of retirement, etc. And it's gas. If you go back to see the discussions on this at a European level, originally our friends in Brussels wanted this pension benefit statement to be 20 pages long.
Lovely.
And people were aghast. Eventually it came down. It's still about 10 pages long, I think.
It is, yeah.
But it was a monstrous piece of information. Whereas if you have a Revolut style, kind of short, snappy bits of information, and unfortunately I have to stick my hands up. I mean, the lawyers are part of the reason why it is 20 pages long. But I think less is more.
Key messages, it's worth this is what you can do with it, this is the income you can draw from it, you know, the key messages first.
Exactly. What happens on debt, as you spoke to earlier. Lots of people don't have a clue about what happens to any pension benefits they have on their debt and what they're entitled to. They wouldn't have a single iota.
Sure. But I guess, Stephen, like, as far as I can see, like, lawyers aren't going away anytime soon. So, you know, so I think... like, to be honest, like, a lot of what Pensions Awareness Week is about is, like, we do have to take the world as we see it, as pension users, if you like. You know what I mean? So I think there's almost an element of, like you said, the mechanic example, it's like you've got to close your ears to all that noise as a pension investor, and you say, well, actually, you know, here's my scope this year, here's what I can do last year, have I optimized and covered my bases within the structure I'm working in? And, you know, those are the questions to
and broadly, what's my investment risk profile as a conservative investor or whatever, you know.
Broadly right is better than exactly wrong, sort of thing.
Better than head in the sand.
So
I think one of the reasons that people don't take advantage of the tax breaks is that an awful lot of people, certainly PAYE people, hardly ever make a tax return. You know, they're not conscious of it. And yet, if we reversed it and said, okay, the government will put X amount to what you're paying. So the 60 euro that you mentioned earlier on, Rafe, and the government is going to add 40 to that. You know, that's very understandable. People can
relate to it.
Yeah, absolutely. Sure. And you know, if they made it more transparent in that way, maybe there would be a better uptake.
Yeah, I think that was similar, Paul, to the SSIA years ago.
Everybody understood that.
Yeah, exactly, and they benefited from it and made sure, whatever way that they made sure they could do it to the best of their ability, because they knew it was a bonus for actually doing it. And I suppose that's what we've got to convey is the bonus effect of doing the pension, you know, the build-up of the assets over a long number of years. You know, it really does pay off. We're focusing today, I suppose, on the professional, people working in professional services, and, you know, I suppose, you know, you're looking across all sorts of professions, accountants, solicitors, engineers, also pharmacists, all sorts of professional services, and it's a feature, I suppose, of a lot of those career choices that a lot of the people involved in those particular sectors maybe would have worked abroad for a number of years. So they might have worked in you know, very far afield in Australia, the US, or indeed worked in the UK. So, you know, again, you know, there can be complications, I suppose, and maybe a certain level of education, I suppose, needed that, you know, that they know that maybe they can bring some of those pension arrangements back, and how does it work? So would you any of you want to comment on that? You know, talking about people trying to recover stuff from overseas in particular.
Well,
first, we look at older
overseas
ranges.
can be quite difficult.
Yeah.
But it is possible certainly to do it. And if you're contributing to the Super Ann in Australia, for example, you can get the whole lot to take away with you if you give up the right to reside in Australia forever.
Okay.
Yeah, if you're permanently migrating back from Australia, you can do that. You know, there's lots of things. You don't even have to have worked abroad, because lots of people have moved around. Like, you take, for example, people in the medical profession, and they've trained in this hospital, and they've gone to that hospital, and they wind up in the third hospital, and so on. And eventually, there's service that can be recognised from all of these places. And sometimes it's very well handled, depending on the HR people that you're dealing with. Sometimes it's not well handled at all. And I spent a lot of my time, when I was pensions ombudsman, trying to unite people with pensions that they had lost track of. And they hadn't kept in touch with the trustees of the pension scheme, they hadn't updated their addresses and so on. And they were trying to backtrack and find these lost pensions that were, you know, out there in the ether somewhere. And very often the companies that they had worked for had long vanished. You
Indeed.
know, like I
Or merged or been taken over, or
I
whatever.
remember one time getting a phone call from a lady who was trying to get a pension because her husband had died. And I said, "Where did your husband work?" And she said, "Clarnico Murray." Do you remember? Iced caramels.
Oh yes, indeed.
Pink and white sweets.
I remember.
Iced caramels. That had been gobbled up by Cadbury Schweppes or somebody, I don't know.
Of that ilk, yes,
years
indeed.
ago.
Yeah,
So then finally I said, who was paying your husband's pension? And she said, Irish Life. I knew exactly who to talk to in Irish Life.
I know.
I
know. So that was the link in your head.
Yeah.
Yeah.
So, you know, there's a lot of work to be done like that. And I mean, in the UK for many, many years now, they've had a very good pension tracing service sponsored by the Department for Work and Pensions. We don't have anything like that here. We should. And even, you know, when pension schemes are wound up, what happens to the money? We put in ads in the paper trying to get people who were in the pension scheme to contact us, and we use the social welfare people to send out letters to their last known address and so on. And we try to unite people with their pensions. But, you know, there are times when we can't, that money is stuck there. We don't know what to do with it. We should have the equivalent of a dormant accounts fund.
Absolutely.
For that, where we can put that money for the people we can't trace.
For their benefit.
For their benefit.
Yes, indeed.
And if they turn up, eventually we'll be able to unite them with it.
And I think that kind of the practical implication of that, Paul, is again, a lot of the work here falls to the user. You know, there really isn't anyone. You know, advisors can help and put a lot of things in place, and, you know, work with the facts to get things done. But actually, it comes down to the individual to actually initiate a lot of this stuff and ask a few questions.
And they're
about
time
that,
poor
and
quite often, and maybe don't know where to start. And I suppose you talk about maybe, you know, trying to, you know, when things go out of date or companies cease. But even if you have a professional person and they've a few different pension arrangements and they want to switch from XYZ Life Office to ABC Life Office, sometimes that can be, even with all of our technology, that can be clunky enough. And, you know, it can take 6 weeks. And you're sort of saying, gosh, we have all this technology now, and yet it can take, and something has to go from one division to the other division. Can we not be quicker, smarter, you know?
The UK came up with a good solution to this, the pensions dashboard, which, I mean, essentially the idea was you'd go to an ATM, that's how old it is, and it'd be able to present you with your pension at any given date. I presume the new idea is you just log onto your phone and it amalgamates all your pension benefits. Now, the issue with the pensions dashboard and what's led it to be parked slightly is GDPR. Just the sharing of information between different bodies, different employers, different sets of trustees and life offices. But it's a great idea, and I'd love to see something like that which amalgamates all benefits. onto
Even to
something
trace it by your
readily used.
PPS number or something,
Yeah.
with your permission, of course, that you know, because it just seems to be layers of work, and I think sometimes that even puts people off reviewing their pensions, even if they at the back of their head somewhere know that they might be losing out a bit, but it's just, they think there's just a huge body of work to be done, worthwhile work nonetheless. And you know, you mentioned GDPR, and I suppose there is that requirement for certain organisations maybe to delete information after a certain point, but let's hope it's not valuable information that will help somebody.
Well, I remember sharing a platform with the former Data Protection Commissioner when he was Data Protection Commissioner, and he was talking about the right to be forgotten. And I had just spent the last few days trying to unite people with pensions, and I got up and I pleaded for the right to be remembered. Because you know, we had situations where money had been transferred from provider A to provider B, and somebody in the middle, let's say an agent or a broker or somebody who was involved, had destroyed records after 6 years or whatever time they felt they were compelled to keep them. And there was a missing link that we couldn't find, that the money had gone from A to B, but where it was in the meantime, we didn't know.
In the system,
And
yeah.
you know, we just found it impossible.
Yeah,
So I had this idea in relation to public servants who are moving from one public service organisation to another, that we might microchip them and put their pension transfer details as they went from one job to another. But even if we had a digital passport that we give to people as they leave service, you record their pension details.
The benefits, indeed, yes, and very, very good.
It's something they can keep on their phone, and they go along to their next job and they present their screen to the HR people and say, "This
they
is
just
where
scan
I'm
it.
at."
It's like your COVID certificate. Here's my pension certificate with all my benefits on. You know, we
Exactly.
jest, but we're not really jesting, because the benefits of something like that are huge.
They are, absolutely, potentially very, very great indeed. And I would like to see something like that. And now that, you know, everybody understands the technology, every 12-year-old can understand what's
indeed.
much better than I can,
Yes.
what's on the phone.
Yeah. And it's amazing how we've all gotten up the, speaking personally, up the technology curve over the last 18 months, because we simply had to, you know. So,
like, we've been quite critical on, you know, there certainly is lots of scope for improvement, I think, on pensions in Ireland, but you know, I do want to say a couple of words
I agree
in
favour. Yeah, I think it's just more accessing the information.
Yeah,
you know, because they've made the provision. You know, and some people have been very sad. So I take your point fully.
Yeah, well,
yes,
that's right.
please.
So, like, I certainly think, you know, real-time access to information on pensions, you know, is available in many cases in Ireland. You know, so that's a matter of straightening out your logins or whatever it might be, and I definitely encourage people watching to do that. I mean, I think, you know, in terms of the UK comparison, you know, it's worth pointing out that the UK pension limits are a lot less generous than the Irish ones. You know, so we've got a €2 million pension
They
cap.
have $1 million, isn't it?
Yeah,
in the
they're
UK?
just slightly north of £1 million. So, you know, so materially worse. You know, and you know, as I say, you know, Ireland has become a big centre, really, in global terms now for financial services. So there's
and thank you very much for pointing that out, because I mean, we do have a generous pension cap, and you know, there's some excellent pension schemes and all of that. It was just more, I suppose, you know, I suppose Paul's comment was in reference to just making it easier, because certainly very good pension, very good tax breaks, all of that, and people are sometimes very pleasantly surprised to discover, oh gosh, I didn't realise that was a defined benefit pension and I have all of these benefits. So, you know, it can be a very positive outcome, but it's just more about, you know, maybe for people who wouldn't be death bound and maybe wouldn't be used to logging in with PINs and all of that, that they work maybe in a, you know, a different type of role or something like that, or just so busy. It's just more that, you know, that there's almost like, well, we're really saying if there was something that could bring a summary of all those fantastic benefits and tax breaks, just a summary,
and just
you know,
to reinforce Ray's point, I think it is.
But I take your point absolutely. You know,
I hammer pensions from time to time, and I suppose that's just a lawyer being critical. But if you do look at it, I think we've got a fantastic regulatory regime there. Yeah. We may not agree with the regulator and all the time, but I think pensions are very firmly regulated in Ireland, which is fantastic. And then also financial advisors. Everyone has access to financial advisors.
They do indeed.
There's a great network of them in Ireland, which is great. I mean, people aren't thrown to the wolves, whether they be professional, self-employed or whatever. There's access to advice out there readily.
Having said all of that, you know, I suppose people, you know, are time poor, you know, a lot as well. So, you know, it's just kind of to make all of, to get the message of pensions across, get the message of tax breaks across, and then just have the information in summary form. Just try and make it easier for professionals or employees or whoever it might be, just to kind of make it easier. And it's back to the education again, back to the access to information. Again, the one thing, we should really try and, I suppose, get from this session today is try and look at it simplistically first. This is a great pot of savings. It can really build it up. It might be spread across different employments or different jurisdictions or whatever, but there's some great advice, there's great legislation and great scope to build up a decent pot. So how do we just kind of bring all that together into a melting pot?
We're talking about professional people here, providers of professional services, and they're very often client-focused, patient-focused rather, and so on. And I remember years ago a man saying to me, I said to him one day, you wouldn't believe how many people are failing to take the tax breaks that are available. At that time, I think it was Richie Ryan was finance minister, and the marginal rate was 70% or something like that. And he said, people in my position are too busy looking after other people to look after themselves.
Indeed.
And that's very often the case.
Absolutely.
And if we made it easy, if we made it understandable for them, I think they would benefit a lot more than they do at the moment.
Yeah, I think so. And switching tack slightly here, I suppose another feature of today's world is the whole area of pension adjustment orders, that people are, we've divorce in Ireland and all of that, and regardless of being gender specific about it, you might find that sometimes spouses don't know each other's pension benefits, or there's children involved and all of that. So any comments from anybody about pension adjustment orders, or if somebody does find themselves in a position where they're getting divorced or separated or whatever, any just general guidance points there, or observations or learnings?
Yeah, well, from a legal perspective, I see all sorts of different pension adjustment orders, from a typical nil pension adjustment order, which means that I'm not going to access the spouse's pension, or the non-member spouse won't access the member spouse's pension, to very complicated ones. And they are not a lot of solicitors in Ireland would have pensions expertise, so sometimes the little nuances with the schemes get missed. But there'd be various different inconsistencies with pension adjustment orders, and often I feel sorry for the judiciary too, who come across these orders which are poorly drafted and hard to put into effect. But yeah, I think that feeds into the whole, what are my entitlements?
Sure.
Like, you may have negotiated 50% of the pension, but will you access that through splitting or through access at the individual's normal retirement age? It's often just a case of, let's draft this order, get it before the court, get the pension adjustment order made, and leave that how it will actually work in practice to a later date. So I've seen all sorts of classes of order, and I'm sure Paul would see this as well, because
it's a feature of life as we know it today. So
I mean, somebody suggested years ago that I would meet the circuit court judges who sit who handle most of the divorce cases and so on. And there was an enormously long discussion about pension adjustment orders, and it was a minefield for them, and it's also a minefield for the providers, the trustees, and everything else. I remember when I was in one of my old employments, sitting down with the head of the legal department to figure out, could we draft some kind of standard communications around pension adjustment orders, and to make it easy for the administrators to meet the requirements of the disclosure regulations. We found that to cover all the bases potentially surrounding pension adjustment orders, we would have to draft 21 standard letters.
I know, yeah.
To cover all the various possible situations that could arise in relation to pension adjustment orders and what happens after that.
Yeah, I suppose it brings it back around to, we're talking about maybe, pensions forming part of your overall wealth pot, and they form part of your estate, but also if there's a divorce scenario, that they're an asset like any other asset, and there has to be a process and whatever. And I suppose that again ties back into, if you have your information on your pensions up to date and current, it makes that whole process easier too for anyone working in professional services.
One of the things that we need to say now, right now, and I always say it at our pre-retirement courses, is if you have an ARF and you're making a will, treat your ARF as cash. You can't set it up on a joint life basis. It's not going to pass automatically unless you say, I leave everything I have to X person, that's fine, they'll get the ARF too. But if you don't mention it, it goes into the residue of your estate, which you've left to the cats and dogs home.
Indeed. No, absolutely. And I think a lot of people don't mention ARF in the will specifically. So Rafe, maybe you could, I mean, this whole session is being held in, I suppose, the concept of in the context of Pension Awareness Week, and a lot of our audience have expertise in different areas, and we, trot out, talking about ARFs and pensions, and most people's concept of a pension would have been what your grandparents would have said, that job will pay you a pension in retirement. But I think it was back in '99 this whole new concept of an ARF it came about, and there are probably people in our audience that sort of, what is this ARF thing they're talking about? So could we just take a breather and maybe just explain what an ARF is? Because,
definitely.
Without oversimplifying it or being patronising to anybody in our audience, but there may be some people who don't get what an ARF actually is.
Yeah, I think, well, briefly on pension adjustment orders, so we do have a separate session as part of the week, which is available on demand with LIA, the Life Assurance Association, specifically on that. So that's worth saying. But coming back to ARFs, I guess, like many other pensions, an ARF is an investment account with some special tax privileges, and should be thought of that way. And building on the theme is another example where Ireland has had a much stronger pension control and flexibility. When they introduced this much later in the UK, they called it Pension Freedom Day. So we should think of the ARFs, approved retirement funds, as something that where we're given a great deal of flexibility in terms of how we use it, but it is no more than a pot of money, an amount of euros which we have investment control over in terms of what we put it into to generate a return, who we pay to both help us with that and actually perform the investment mandate, and how we draw it down. I think. So it's not somebody,
paying you a pension. So it's not the employer or your company giving you a pension from all your years' work. This is basically a pot of money that you build up. You have the choice then when you decide to retire your pension or retire from working, and they may be co-termers, they may not be, where you can actually say, right, I can take a certain amount out tax-free, as you referred to earlier, and then with the remaining pot of money, I can manage that or have someone manage that for me. So it effectively becomes an asset that I can almost draw my own pension from at frequencies and amounts that you can choose as you go along. So again, great flexibility.
Yeah, very, very flexible, and I guess a relatively new concept, because the generation of people for whom this has been in place is only now, I guess, starting to retire, and it does feel quite unfamiliar territory for a lot of those people. If you've been in a large organisation or just had your pension kind of boxed off, direct debit every month paying in, and suddenly you hang up your boots, that income stops, and now I've got a decision to make. Otherwise there's no paycheck next month. So it is something that you need to kind of actually tackle, get to grips with. But it should be regarded as I say, we're dealing with kind of highly educated people who are intellectually confident and able to get to grips with this. So I think it's a great facility to have, and I suppose what we're likely to see over sort of a 10-15 year period, I suppose, is many people drawing their income in that way for the early years of retirement, but perhaps later in life moving to the kind of old way of that was the norm, which was annuities, guaranteed income for life. So there's what I could see happening is a lot of people switching into those types of structures when they get tired of talking to people like me about investment strategy, and want their later years to be paid at a better rate of annuity, and life to be a little simpler.
Sure. I know I certainly in practice you would come across people who say, yes, I'm going to draw down a certain amount every year, and some people say, I'm going to draw down the lot, I'm going to really enjoy it, and then other people say, well, look, I'll draw down what I need and I'm going to leave the rest as an asset for my spouse or my children or whatever, subject to the various tax rules or whatever. So you come across, and again, as you say, Rafe, along the sort of post-working journey, they will maybe change their mind a little bit, as they go, or maybe they suddenly say, well, this year I need to draw more from my ARF because I want to spend money on X, Y, Z or whatever. And it's that great flexibility that you're not tied into this may be a low annuity rate or a pension that's fixed, so you can flex it to suit your other financial needs. And I suppose, when you want to draw on it, and coming back to our pension awareness, the key is, if you have this asset you want to draw down on post-retirement, the thing is to get that pot as big as possible.
Indeed. And that means the earlier you start, the better.
Exactly. Yeah. So it's the old kind of almost the compounding interest sort of theory, really, isn't it? And people do worry about, I suppose, when they're managing their own pension or managing their own ARF, and they see maybe a blip in markets, they kind of go, oh my God. But that happens in occupational pension schemes as well, which their employer might be managing, but they just don't see it. And we've had all these Black Mondays and financial crashes and COVIDs last year, but over time, the line usually goes up. But it can be painful when you see maybe your ARF or some of your assets temporarily be subject to volatility because of some political event, or recessions come and go. But it's the pensions and ARF journey, they're long journeys, and things do smooth out over time.
I think the mistake a lot of people make is confusing volatility with risk.
Yes.
Because risk is only present if you have to get out.
Yes. Indeed, at the wrong time, or
exactly. I think if things are bombed out temporarily, and you have to get out for whatever reason, that's risk. Volatility means that you may be able to recover.
Yeah.
Yeah, okay. And I think not to mention the C word at the start of the whole COVID panic.
Yes.
I think one of the key pieces of advice that trustees of pension scheme were given was to avoid any knee-jerk reactions.
Absolutely.
I mean, we didn't know what was going to happen, but we knew that for sure and certain from previous financial crashes, if you make knee-jerk reactions, you'll regret them, because pensions are a long-term investment.
What we did see, was central banks act so quickly this time out, to reassure people, and the markets actually rebounded much quicker than they did at the time of the financial crisis, because I think when our financial crash happened back in 2008, everybody was in denial for ages, but this was a real live thing, that was affecting everybody's health, their job, everything. But nonetheless, people still had to eat, they still had to consume certain services. So all of those companies that our pension funds invest in, life does go on, but it's important not to panic in the moment, I guess. Kind of conscious we're coming nearer the end of our discussion here today, which has been really interesting. And Rafe, you mentioned the fantastic tax breaks and benefits and flexibility we have in our Irish pension scenario here. But do any of you, would you all, and maybe this is a bit of a loaded question, would you all see those fantastic benefits continuing? We often hear, things on the radio or the television, reduce the pension cap, or, tax breaks are going to be reduced. Indeed, we saw the pensions levy come in at the time, when Ireland was in crisis. So, I suppose enjoy the things, enjoy all these benefits when they're there, maximise them. Would you see any change in the wind? Any of you in relation to any of those benefits changing, or?
Well, I think an article recently in the Irish Times that I didn't like at all, that was talking about abolishing the tax-free lump sum.
Oh wow, yeah. And abolishing it as opposed to reducing it. My goodness.
Just withdrawing that privilege, and I mean that's one of the sales that drive the whole pension thing. It's one of the great advantages that you can get some of that money back without paying tax.
Yes.
So, well, I'd like to see a stop to tinkering with pensions. As you mentioned, more of the pensions levy, that's certainly eroded some confidence in pensions, as did what happened, to the National Pensions Reserve Fund, which was essentially used as a rescue fund. So that has that's eroded confidence.
But we've come through it all again.
I'd like to see that confidence go back.
Yes.
And I think it has, but there's a move to simplify pensions, which is great, but I think recent moves have complicated to a certain extent. So I'd like to see the simplification process go on and to greater explain the massive benefits to pensions in Ireland through that process. But my one wish, if this was Christmas, would be to stop the incessant tinkering with pensions.
Okay, and just have
have
it laid out simplicity.
Yeah.
Okay,
a bit of certainty.
Yeah. Okay.
I guess for my part, I'd say, as advisors and professionals, we're used to dealing with complexity within our own professional sphere, and kind of expect that customers, if I'm a medical professional or a legal professional or whatever, come to us so that we can navigate them through a particular set of
Guidance.
facts, and like the bottom line is, professional people in practice or wherever it be have there's probably quite a lot of nuance to their employment trajectory or their career trajectory, which creates opportunities to add a lot of value. So, it's not all bad that there is complexity here, and certainly, by looking at the specifics of your situation.
Sometimes complexity, examining it, can actually reveal additional benefits.
Yeah, it creates opportunities, So I'd say actually this group of this sector, the professional sector, has opportunities that you can definitely work within to extract a bit more value.
In 3 words: communication.
Okay. So, I mean, the message I'm generally getting here today, by means of summing up is, this is a fantastic opportunity to save. It's tax effective savings. So that's message 1. So do it. Don't let the tax break go a begging. That's number 1. And I suppose number 2 is to be aware of what's in your pension pot already, no matter where that's come from. And if you're a little bit unsure about it, go to the many plethora of advisors, be it financial advisor, legal advisors, and to make sure then that, from financial planning purposes and indeed for estate planning purposes, that you're very familiar with your pension arrangements as well. And in some cases, those are very generous indeed. So would everybody be added in with me on the message that we're giving out to, a final message to our audience?
Yeah, I think so. And both the Department of what used to be called Social Welfare, for what it's called now.
Social Protection, I think.
Social Protection, okay. And the Pensions Authority have pensions calculators online where people can actually go in
Get
and
a feel
see
for it.
what they need to be saving if
To
they have a
generate.
particular target that they want to meet in terms of their retirement provision eventually. And they're very useful tools, and they're very simple, and they're easy to use.
Okay.
Yeah, for my part, I'd say, it's rare that we would look at somebody's situation and not find a way that you could materially improve it.
Or maximise the benefits, or draw benefits down in a certain way. They don't all have to be drawn down at once, for example, and all things like that.
It's all about initiating that and taking action. And I guess if you've got this far in this webinar, you're probably on the cusp of that action. So I definitely encourage folk to lift the phone or shoot that email across and take some action.
Okay. Well, it just remains to me then to thank everybody here today. I mean, we could chat for hours on this subject, but it's we're ending it on a positive note, which means it's pensions are a positive thing to initiate and to do and to review. And it's just up to me now to thank all my participants here today. Rafe Benson, founder and director of MoneyCube. Stephen Gillick, partner in Head of Pensions in Mason, Hayes and Curran, and Paul Kenny from the Retirement Planning Council of Ireland. Thank you very much indeed for your time today, and thanks indeed to iconic offices here in the Masonry in this lovely location here in Thomas Street. And anyone who wants any further advice, please go on to the pensionsawareness.ie website, where you'll be able to indeed maybe look at some of the other sessions and everything that are available. And there's a profile of all the participants on that website as well over the course of the week. So thank you very much indeed.